Scott Wolle, it's hard finding yield in this market. So are investors getting paid enough for the risk they're taking in high yield right now?
Well, high yield, you can think of it in a couple of ways. One is the spread to Treasuries or just in absolute terms. We think the right way to start to look at it is really in absolute terms. So you get roughly a 6% yield now. But when you think about how much you're getting paid relative to how much you can lose in those bonds on a standalone basis, you're still looking at an asset where in the really bad times you can lose 20 or 30% of your money.
All right, so that goes for high yield. What about the bond proxies, utilities, and REITs and BDCs? Same question. Are you getting paid enough for the risk you're taking to own these?
Well, in a sense, it's the same answer to the same question, where if you think about REITs, they've had an extraordinary run this year. A lot of that on the back of rising dividends, so they haven't gotten a lot more expensive, but still you're not getting a tremendous amount of yield for the kind of price risk that you're taking on.
Another place where investors traditionally find yield is in emerging market bonds. So what's your answer for that one? Same as the same song?
Exactly. Same song, different verse, where those assets had been more or less shunned by investors for some time. But now yields have come down as investor enthusiasm mounted for emerging market bonds. And so you're, again, getting yields that are at the low end of the last 10 years where you're still taking on that price risk. And so our view is that any of those on a standalone basis may make sense within a portfolio, but we think that there are ways where you can put them together with other assets to make them more appealing.
All right, so put it all together for me. If I want to get some income, and everyone's desperate for income now, how would you do it?
Well, and we think that income is fine on its own, but it's really the combination of yield, but having a level of defense, and also having a chance to grow your assets as well. And so the way that we think about that is having a diverse set of yieldy assets, but combining them with other assets that should behave more like a safe haven. And so that's where you start off with the yield. And so we think investors can achieve somewhere around a 5% yield with that kind of set of assets. Now, the second piece is that defense. Now, having something like a Treasury can help to defend a little bit, but we don't think that that's enough. What we think investors also need to do is think about how to get tactical exposure away from some of those higher yielding markets when things get risky. Now, the way that we happen to do that is with futures. Conventionally, a lot of investors will take those, sell cash bonds and move into Treasury bills or something else to reduce risk. The trouble is, that you're going to reduce yield, you just don't know whether you're going to time the market properly or not. And so futures are a much better way to do that, using equity futures, which are a good proxy for the spread behavior in bonds, as well as bond futures to eliminate some of that interest rate risk when appropriate. Then the growth piece is, in some ways the easy one, where when you include assets like MLPs and REITs, they should naturally have the tendency to grow their dividends over time and therefore keeping up with inflation. But also that tactical piece that I talked about to defend, you can also use that to grow. And so when we're bullish on risky assets, then we can increase our equity futures, again, a proxy for bond yield spread, to make sure that we can get those capital gains for investors.
All right, well, thanks a lot for coming on and telling us how to spread out our assets, because you put too much in one, you're in big trouble. Thanks a lot, Scott Wolle.
Thank you.
And thank you for watching The Street.